and hello again, everyone. It's good to be back. We've got another really interesting day ahead for you, some high-level insights as well. But of course, as always, we really would like you to be involved too. Don't forget we have that chat box function available just for you to send us your questions whenever you want to, whenever they sort of pop up, put them in the chat box and we'll get them to the teams and try and get them answered for you. So we're going to start off though with some of our first panelists of the day, and I know you'll have some questions for them, of course, because they are looking at the outlook for pensions. Nick Adams, Global Head of Institutional, is looking at a busy, Nick, and challenging year ahead in the pension sector.
Great, thank you very much, Lucy. And hello, welcome to our pensions panel at the Janus Henderson Global Media Conference. As you just heard, my name is Nick Adams, so I'm Global Head of Institutional at Janus Henderson. And this panel is me looking at our outlook for pensions. We put together a panel of experts for you representing different pension markets around the world. I'm joined today in London by Anil Shenoy, our Head of Institutional Business in the UK. In Amsterdam, we have Sander van der Ent, who's our Head in Europe and the Middle East. And we're also joined in Denver by TF Meagher, who leads our business in North America. So, we have some pretty different markets represented across our panel. So why don't we start with some common ground, the influence of regulation. And maybe Sandra, if I can come to you first. EU regulations, how are they influencing the investment behavior of your pension scheme clients?
Thank you, Nick. And it's a good question because regulation plays an important role for pension funds. And they're actually dealing with both local and EU regulation, which sometimes is actually a balancing act for them. And if I have to give an example of more recent EU regulation, I would name the Sustainable Finance Disclosure Regulation, which is also known as SFDR, because this is really impacting how Dutch pension funds are coping with their ESG ambition, because they have to classify this in one of the three categories. And going forward, most Dutch pension funds will opt for a light green classification, which in the fund's terms is also known as Article 8, and they're working towards that. And this is a clear example of how this shapes client demand and also ESG reporting requirements. And in the end, that filters down to asset managers like Janus Henderson, because we are managing a part of these assets.
Great, thank you, Sander. And Anna, in the UK, regulatory drivers there maybe again on ESG.
Thank you, Nick. Well, turning to UK pensions, trustees of pension schemes are having to grapple with a whole array of different ESG-related regulations. Probably the most pertinent one right now, which is on the agenda, is with regard to TCFD, where the regulator is asking pension schemes to operationalize and internalize TCFD principles within their assets and liabilities. This happened in October last year for pension schemes over 5 billion in size, but it'll be rolled out for pension schemes over 1 billion in size in October this year, and is likely to impact all pension schemes in the following year. And industry best practice is currently being developed as we speak. On the insurance side, well, they haven't escaped either. The PRA is also looking at climate scenario testing for insurance companies through their surveys. They've made it quite clear that there is no capital charge that will be ascribed on the basis of those scenario testings, climate scenario testing. But our view is that this is a possibility in the future, that certain insurance companies will need to hold capital with respect to climate change on their assets and liabilities. So lots of regulation, ESG regulation in the UK, certainly.
Okay, and finally, moving across the Atlantic then to TF, how's regulation shaping the behavior of your pension scheme clients there?
Sure, thanks, Nick. As Sander said, despite a lot of these issues being local, they are very similar in nature. So I'll touch on two topics. The first being ESG and climate risk disclosure. We're definitely seeing a lot of regulation to help prevent greenwashing and create more consistent reporting across the industry. In the US, a few years ago, I don't think a lot of people would have thought that we would be moving this quickly, but we are. The US is definitely behind the UK and Europe, generally speaking. And one of the benefits of that is that we can play catch up by following the playbook that's being created out of Europe and the UK. Separately, as pensions continue to move into less liquid asset classes like hedge funds, private equity, and private credit, the SEC is responding by proposing additional reporting requirements in Form PF so that there's better transparency into potential default events, and also just transparency in terms of the terms that investors are having within their alternative investments. And while this is operationally burdensome for a lot of asset managers and pensions, it's really the right thing to do to protect investors in the financial system. There was just an update on this yesterday that the SEC released. So that's also going to be moving really quickly in our market. And I do think it's going to have a profound impact on what the alternative investment industry looks like going forward.
Okay, so we have different markets, but maybe no surprise that ESG is a common theme coming through. Although, as you note, TF, different regions, different parts of the world at different stages of their development. Let's focus in a bit more on the investment side and turn to fixed income, seen as a natural asset class for pension scheme investment, particularly on defined benefit, but not just. What sort of trends are you seeing with your client base when it comes to fixed income? And maybe, Anil, if I can come to you first on that.
Thanks, Nick. So picking up on the theme of regulation, another regulatory change which UK pension schemes, particularly defined benefit pension schemes, will be looking out for is the pension regulator's new funding proposals and the funding regime, which is under consultation and will hopefully progress in the summer. This is really interesting because it measures investment risk in a new way, and it measures investment risk using stress tests. And the level of investment risk a pension scheme can hold will be conditional on the covenant strength and the maturity of the pension scheme. Now, this means that the trends that we've seen hitherto, where pension schemes have been allocating more and more to fixed income, we think will continue to accelerate. So there'll be more and more fixed income coming into pension schemes, and ever larger portion of their asset allocation will be towards fixed income. In addition to that, looking at TCFD again, long-dated credit, which supports infrastructure, social housing, and so on, will be popular. That's what we think, and that'll continue to be a focus both in this year and in the future. And finally, going back to the maturity point, a lot of DB or defined benefit pension schemes in the UK are pretty mature, and so they'll be looking at cash flow, and that'll be a continued focus for this year. Pension schemes are looking at how much cash flow their assets can deliver and how they can pay their pensioners on time. Lots of issues to grapple with in terms of the investment side of things.
In contrast, TF, coming to you, we know that forward-looking return assumptions play a big role in setting investment strategy. How's that affected the use of fixed income in pension schemes there?
Yeah, this is a really interesting question, Nick, and I'd really break down the US DB market into two different areas. The first being the corporate DB market, and the second, the public pension DB market. And if you look at defined benefit plans in aggregate in the US right now, they're actually very well funded following really strong equity and bond markets over the last several years. So the aggregate funding status is around 96% at year end, according to Willis Towers Watson. And that's the highest it's been in decades. So pension plans are actually in a really good place. And if you look at corporate pension plans specifically, they're using fixed income to match their liabilities and really de-risk their plan. They're also looking a lot at pension risk transfer to really take the liabilities off their balance sheet completely. Contrary to that, if you look at some of the public pension plans, especially the more local ones, not the state plans, but the more municipal plans, they're actually, for the most part, in a lot worse shape from a funding status. And they're actually looking at fixed income and taking on more risk by going down the credit quality spectrum, because they're really trying to earn their way out of being underfunded. So it's actually pretty contrary use of how fixed income is being utilized across the different types of defined benefit plans in the US today.
Great, thank you. I'm going to change tack slightly now. Talk about governance. Much has been written about the importance of governance around pension provision, and various solutions rolled out across the globe to address this. Maybe if I can come back to you, Sander, how have you seen governance evolve in the Dutch pensions market?
Thanks, Nick. And indeed, governance has been discussed for a long time now. And actually, there has been pressure on pension funds to straighten their governance model since the financial crisis back in 2008. And I do believe that a lot of steps have been made in the right direction to improve this. And just to give you an example, specific legislation has been implemented in the Dutch market, which we call the Pension Fund Governance Act. And this aims to improve the expertise of board members so they become more professionalized, to straighten internal supervision, and also to improve risk management. And in the Dutch market, the pension funds tend to work with a fiduciary asset manager. And as a result of this improved governance, they became more in control and less dependent on their fiduciary asset manager. And I actually think this is a very healthy situation. And I also do believe that governance will continue to evolve going forward because we are in a situation of ongoing consolidation. We had over 1,000 pension funds. Now we have around 200 pension funds. And also there's an upcoming large reform of the Dutch pension system, and that will all have an impact on governance.
Yeah, it's a topic that's really shaped that market. TF, by comparison, how's governance looking in the US?
Yeah, this is a topic that a lot of boards, pension boards, are trying to quantify as much as they can. There's some research out there that supports a really strong link between having best practices in governance and strong long-term investment returns. Most recently, there was a report out that showed you can create almost 2.4% better investment returns if you have strong governance practices. So having a really strong risk management framework is an area where boards are spending a lot of time on trying to reduce not only investment and operational risk, but also reputational risk. Because when you have negative reputational risk, that generally creates less continuity between investment staff, boards, and the service providers, such as us. And it also creates a lot less certainty in the market in terms of how quickly investors can adapt to a fast-moving investment market. So it's an area of focus in North America, and I think it's one that is becoming more and more important at the board level.
Anil, any other aspects of governance you'd like to touch on from the UK?
I echo my colleague TF's view about the importance of governance. That's certainly a critical issue for pension schemes. And if you look at the UK, having been at Janus Henderson for quite some time now, I've seen the radical improvement of governance in defined benefit pensions. Trustees and their advisors have been congratulated on really focusing the trustee meeting on strategy and strategic asset allocation, which is quite different to what it was when I started many years ago. It is a considerable improvement. With regard to looking to the future, I echo Sanders' comments about consolidation. That is a big theme within the UK. There's an argument there that a bigger pension scheme with access to a greater array of strategies is beneficial, particularly for the smaller scheme, which you don't have that economies of scale. And also the professionalization of trustees. One big change that we've seen is a lot more independent trustees coming on board, often chairing pension schemes, and the value of an independent trustee with the independent insight and experience that they bring is of considerable importance to pension schemes and has further contributed to that improvement in governance. So we continue to see that trend over the next few years.
So quite a number of changes still coming through on that area. Thinking about time here, I want to leave some time for questions and answers at the end. So maybe just to wrap up, looking ahead, can I ask each of you about primary areas of focus, big priorities for the pensions markets in your region? And maybe again, start with you, Sander.
Yeah, that's clear. Let me name some. For example, climate transition, inflation, rising interest rates. They're all on the agenda because this has an impact on the return and liabilities portfolios of pension funds. And as I mentioned earlier, on top of that, there is an upcoming new pension contract, which will impact 2 trillion of assets in euros for the Dutch market, which is in essence a transition from a defined benefit to a defined contribution system in an effort to keep the system affordable in times of aging population. That's similar, as Anil mentioned, in the UK. And also the low interest rate environment doesn't support that, and also the need for more transparency. And this will also impact the investment perspective because we believe that certain trends are enforced. This will mean more focus on return generating less liquid assets, such as private debt, for example. And there will be likely less need for hedging of liabilities portfolios to a certain extent, and that could also impact the demand for the longer end of the yield curve. So actually a lot of things on the agenda.
TF in the US 2022.
Yes, I think, as Sander said, ESG and climate change is that's a global topic, and one that's going to continue to be relevant, obviously, in the US and North America. I think in another area that's been underreported on is actually the amount of illiquidity that pension plans have been taking on over the last decade plus. If you look at the amount of capital that's gone into private equity, private credit, and hedge funds, investors' portfolios have become much less liquid. And the reality is we have not had a significant and prolonged market drawdown in quite some time. And I stress the prolonged drawdown because if there is one, I do think investors are going to have to really focus on what the liquidity profile of their portfolio looks like, because I think they're going to have a lot less flexibility than they had 10 plus years ago in their portfolio to capitalize on market drawdowns and potentially be adding risk at that time.
Yeah, interesting point on illiquidity. Anil, to wrap up your views on 2022.
Thanks, Nick. I'll leave with three reviews. Our favorite acronym, TCFD. Trustees of pension schemes will need to work to aggregate the data at the top level across all the different managers with regard to TCFD and ESG data. That is not a straightforward exercise to do. Managers may give different kinds of data in different formats, or some of the asset classes may have incomplete data simply because that's where the market is. So that's number one. Number two, I'd say planning for the end game. So the long-term objective of UK pension schemes is generally going to an insurance buyout, as TF mentioned, or self-sufficiency. And we're in 2022. Many schemes are aiming to achieve that long-term objective in 2030, which is 2030 to 2035, which is not that long away. So planning for that, and again, focusing on cash flow generation. And the third is education of members. And it is important for people, particularly in DC schemes, to understand their pension scheme. And one of the things that I was thinking is, in terms of the cost of living and the increase in inflation, well, it can be challenging for people to contribute to their pensions. So trustees will have to help their members, educate them the importance of pension scheme investing, given the other competing dynamics in terms of what people have to spend. So I think those are the three things that we need to look out for.
Plenty to look at for the current year. Thank you. Some questions have come through, which I'd like to just get through a couple of those before we run out of time here. One for Sander. You mentioned earlier inflation and interest rates as topics on the agenda for the Dutch pension scheme industry. Have you seen the pension schemes adapt their investment strategy accordingly?
Actually, very limited in that sense. There are only a few pension funds who added more to commodity future programs, which can be seen as a kind of inflation hedge. But actually, most Dutch pension funds are managing this through their liabilities book. They decided not to have a full hedging program there. So, which means as long as there's a linkage between inflation and interest rates, that increasing interest rates will limit their liability going forward. So that has a positive impact on the funding ratio. So they're managing it through that, but this might change if the linkage between inflation and interest rates will be different. But for now, that is what most pension funds are doing.
Maybe a little bit linked to that, one for you, Anil. Will rising bond yields accelerate allocations to fixed income in pension portfolios?
Yes, I think they will. Certainly, rising bond yields on its own will reduce the liabilities and improve the asset liability profile of the pension scheme. And so it'll get them closer to the end game, closer to their end objective. And as a result of that, they'll take risk off the table and allocate them to more bonds. That is certainly one scenario.
Okay. One final one. Back to you, Anil. You finished by mentioning DC in your outlook for 2022. One here, there's talk about increasing the charge cap for DC members in the UK. Do you think, and that's to allow more investment into illiquid asset classes, what's your view on that move?
It is certainly of interesting debate. This has been capturing the papers recently. In terms of removing the charge cap or amending the charge cap, it value for money is important for pension scheme members, certainly. But also allied to that is giving pension scheme DC members the same access to the same asset classes that DB pension members enjoy. So careful allocation to those different asset classes, I think, is ultimately beneficial.
Very good. At time, thank you very much, panel. Really interesting discussion, lots of ground covered there. I hope you found this helpful and interesting, and that you'll continue watching more of our panels on today's Global Media Conference. Thank you.
Nick, thanks so much. It was really great to get those regional perspectives there, you know, to hear from you, not just in the UK, the Netherlands and the US as well. So thanks so much for that.